The most dangerous risk in markets feels like safety. When prices rise steadily, headlines turn optimistic, and everyone around you seems confident. Risk appears to disappear, but historically, that is often the moment it is quietly building. Market bubbles are not accidents, they are psychological cycles. They begin with a compelling narrative, a technological shift, a structural change, a belief that old valuation rules no longer apply. Early gains attract attention, attention attracts capital. Rising prices validate the story. This is where human behavior takes over. We anchor to recent returns. We extrapolate trends. We feel social pressure when peers appear to benefit. The fear of missing out becomes stronger than the fear of loss. As more participants enter the market, demand pushes prices higher. Higher prices reinforce optimism. Optimism reduces perceived risk, and reduced perceived risk encourages larger positions and sometimes leverage. This feedback loop is powerful. In institutional finance, we do not describe bubbles only in terms of price charts. We analyze behavior and structure. Are risk premiums unusually compressed? Are valuations detached from long-term earnings capacity? Is investor positioning crowded? Is liquidity abundant and cheap? Is leverage increasing across the system? These are not predictions of collapse. They are indicators of fragility. A bubble becomes dangerous when portfolios are built on the assumption that volatility will remain low and prices will continue rising. When expectations narrow to a single outcome, resilience declines. Notice something important. Bubbles are rarely obvious while they are forming. At each stage, there are rational explanations. Innovation may be real, growth may be strong, optimism may be justified up to a point. The psychological shift occurs when probabilities are replaced by certainty. Institutional portfolio construction approaches this differently. Rather than asking, how high can this go? We ask, what happens if our assumptions are wrong? We stress test portfolios under adverse scenarios. We examine liquidity under pressure. We monitor concentration risk. We assess correlation shifts during market stress. In euphoric periods, correlations often appear low. Diversification looks effective. But during sharp corrections, correlations tend to rise. Assets that seemed independent begin moving together. That is why risk management is most important when markets feel calm. Another psychological element is time horizon distortion. During bubbles, investors shorten their evaluation window. Short-term gains dominate thinking. Long-term cash flows become secondary. Price becomes the narrative. Disciplined investors reverse this lens. They extend time horizons. They separate price movement from fundamental value. They evaluate expected returns relative to risk, not relative to recent headlines. Importantly, institutional thinking does not require predicting when a bubble will burst. Timing turning points consistently is extremely difficult. Instead, it focuses on exposure management. Position sizing reflects uncertainty. Liquidity buffers are maintained. Diversification is preserved. This approach accepts that markets are driven by human emotion as well as data. It recognizes that optimism and fear move in cycles. When euphoria peaks, risk is often underpriced. When panic dominates, risk may be overpriced. But both extremes are emotional states. The psychology of bubbles teaches a simple but powerful lesson. Stability can create instability. Extended periods of rising prices encourage behavior that makes the system fragile. For university students and developing investors, the most valuable skill is not identifying the next booming asset. It is understanding behavioral bias in markets and in yourself. Ask reflective questions. Am I relying on recent returns to form expectations? Am I following consensus without independent reasoning? Is my portfolio resilient to unexpected volatility? Calm investing is not passive. It is intentional. It requires stepping back when narratives feel overwhelming. It requires humility about what we cannot predict. And it requires designing portfolios that survive uncertainty rather than depend on perfection. Markets will always cycle between enthusiasm and fear. That is part of their nature. The goal is not to avoid every bubble. The goal is to remain disciplined while others become emotional. If this perspective helped you think differently about market behavior, reflect on how psychology influences your own financial decisions. Education is the first layer of risk management.